Good morning and welcome to the Media Macro Review 2024. We will start with I wouldn't say a long presentation by my colleagues. The idea of doing a media review is for us at the Institute and for everybody else who's interested to go over available information as of date to figure out what the world looks like, what economy looks like, and what hopefully identify for ourselves stress points or challenges that might be emerging in the times to come. We have for the first session Rudrani, Radhika, and Manish doing the presentations in a panel format with Dr. Sudipta Mandal leading and anchoring the discussion. We will have Professor Pamit Dua coming in a few minutes. I guess none of the panelists and the discussant don't need much introduction. Since I'll presume on my colleagues, but since Dr. Dua is coming pretty much for the first time in the last few years to an IPF pitch, so brief introduction. Given an illustrious career that she's had, she's was a senior professor at Delhi School. She was a member of the first Monetary Policy Committee of the RBI. She has taught extensively and written extensively on time series econometrics, macroeconometrics. She's recently putting out an edited volume on macroeconometric methods applications to the Indian economy. We look forward to her interventions to make this discussion more meaningful, but in the time that we have today, it's good to start. So over to you, sir.
Yeah. Thank you, Kavita. Let me join Dr. Rao in welcoming all of you to this media review. We've been doing it now for a few years, twice a year. One in the beginning of the year after the budget and one around this time when we know the outlook for agriculture and so on. The format, as she said, we'll go through the presentation. At the end, I'll just try and summarize the main takeaways, and then we will have Professor Dua giving her comments, and then we'll open it up for discussion from the floor. So no need for me to say anything more. So let's start off first. Radhika will give us a bit of the global outlook because she handles the external sector. Then Rudrani will take us to the performance in the real sector, inflation, employment. Then for the external sector, Radhika will be back, and then she will also take us through the monetary policy, financial sector performance, and then finally Manish will deal with the fiscal situation both at the center as well as the states. So with those few words, if I may now request you, Radhika.
Sir. Thank you, sir, and good morning. So first session is on global developments. We look at some of the global growth projections that have been put out by standard setting bodies, primarily the IMF. So just a couple of days back, the IMF came up with this October edition of the World Economic Outlook. And the snapshot is that the global economy is recovering, but it's recovering at a very slow pace. And there is a heterogeneous pattern of growth. So global growth is projected to grow at 3.2% in both 2024 and 2025. Advanced economies are projected to grow at 1.8%, both the years. But if we look at the composition, there is a lot of variation. Growth is mainly driven by United States. Last 2 years, we've had a lot of discussion, and there were a lot of concerns that United States is going to fall into the grip of recession, but that did not happen. And if we look at the various macro indicators of the US, it is growing at a robust pace, though there is some signs of weakness, but we don't see any sustained slowdown. And therefore, the global advanced economies growth is primarily being driven by US. If we look at the EU economies, there is a slowdown in most of the economies. Emerging market and developing economies are projected to grow at 4.2%. That's a stable growth that is projected for both 2024 and 2025. Within that, emerging and developing Asia is projected to grow at 5.3 and 5% respectively in 2024 and 2025. India's growth is retained at 7% for 2024 and 6.5% for 2025 as per the IMF, and it's closer to what the RBI is projecting for the current financial year, which is 7.2%. Though in the first quarter we did see some slowdown, but overall, as of now, growth is projected at 7% for the current financial year. What's the position on inflation? So if we look at inflation of some of the advanced economies, we see that there was a period when globally inflation was rising, particularly after the Russia-Ukraine war, because of the volatility in global commodity prices. We saw inflation rising to almost 9 to 10% in United States. In Euro area, it was rising. And so in most of the advanced economies, inflation was a more critical problem. But since then, now we are seeing, because of the sustained monetary policy tightening and also improvement in the supply chain bottlenecks, we are seeing a moderation in inflation. And in most of the economies, we are seeing that inflation is moving towards the inflation target, which is 2% in most of the countries. And therefore, most of the global central banks have embarked on the rate cut cycle. So there was a period in 2022-23 when most of the advanced economies were increasing the policy rate. And now we are seeing that this year, particularly, most of the central banks have started easing policy rates. European Central Bank has already eased thrice. So there has been 25 basis points reduction over the last 3 meetings. US has reduced rate by 50 basis points quite unexpectedly. So we are seeing a decline, though the risk is again the volatility in the Brent crude prices, because in September crude prices were declining, but in October, due to the escalation of conflict in the Middle East, we are seeing that oil prices are again witnessing volatility. So that could pose an upside risk to inflation trajectory globally as well as in India.
Thank you, Radhika. So it's a very challenging external situation, and it is against that background that we're going to review how the Indian economy is doing. So for that, request Rudrani to take us forward.
So coming to the domestic front, the Indian economy.
Ravi, come closer to the mic because they won't be.
The Indian economy grew at a very high rate of 8.2% during the last financial year of 2023-24. However, in the beginning of the current financial year, in Q1, there is a growth moderation. This moderation is on account of compression in the government expenditure during the election time, mainly, and increase in the contraction in net exports. But however, the good news is that the private consumption growth has shown a pickup in the first quarter of this fiscal, for a moderate growth, having a moderate growth rate for the entire fiscal of the last financial year. Now the private consumption is growing at a rate of 7.4%. Investment growth that moderated in the last quarter of the previous fiscal has shown also a pickup in the first quarter. Now, if we come to the sectoral picture, first, the gross value added has grown at 7.2% in the last financial year, and it's moderated to 6.8%. The moderation is mainly in the services component, the tourism, travel, and financial services. So these are the components which have dipped the growth in the first quarter of the current fiscal. However, we see an improvement in agriculture from the last quarter, and public administration services is also buoyant in the first quarter of the current fiscal. Now we come to we look at a selected.
Rani, sorry, you mentioned earlier that government consumption expenditure has dipped because we know the election code of conduct and so on. But public administration, which is a large part of that, has not. So you have any thoughts on that?
So this public administration that is mainly comprises of the wages, salaries to the government employees, and also that has increased in a robust rate. However, the public expenditure in the national accounts that is that comprises of some of these components and some investment components. So there is maybe some compression in the investment would have been
and maybe things like, I mean, the employees had to be there, so that had to be, I mean, government employees, but maybe some compression in subsidies and what the Prime Minister called, what is it, reveries and those things, I think were compressed.
We have been discussing, and so it was like in some of the investment projects where the salaries, where the employees are working, so there the salaries and wages are given to them that come under this category. So that's why there's a compression in the investment. There is a decline in investment projects is actually reflecting that decline in that component.
Okay.
Now we look at a few selected high frequency indicators to understand that what is happening in the current quarter and what is going to happen in the coming months. So first, the agricultural sector, the gross area sown under Kharif crops have increased at a rate of 3.7% this year compared to the last year. And also there's a plenty of rainfall, good monsoon, and there's above average rainfall during the end of the monsoon of this year. That is going to favorably affect the rice production, whereas the pulses production may be hit because of the increased moisture that may affect the pulses production. So there are like kind of mixed outcome we can see in agriculture to come. Coming to the industry, during the first half of the current fiscal, it has grown at a moderate rate of 4.2% compared to the same period during April-August of this year compared to the same period previous year. This moderation is on account of there is a moderation in the growth rate of manufacturing and contraction in mining and electricity. And within manufacturing, there is this contraction. The dipping of growth is also seen for consumer durables, capital goods, and construction. So overall, because of this dipping of growth rates as well as contraction in electricity and mining, the overall IIP shows a contraction in August, and but however, with coming festive season, the festivals are coming, so it might be going to pick up the momentum in the next few months. Services, again, we see a mixed picture. So the first panel is the tourist arrival. We see that it yet to recover. The level of number of tourists arriving in India, that is yet to recover to the pre-pandemic level. And compared to the last year, the growth has moderated, mainly due to rising geopolitical tensions. And however, the trade, which declined in the last fiscal, we see there is a pickup. The second panel, second top panel, we see a pickup over there. Tourism moderating, trade buoyant. In financial sector, we see that the non-food credit growth is declining, but growing at a moderate rate of 11%. However, the assets under mutual fund is growing at a increasing rate and is a very high rate of 44%. So there is again mixed picture within the subsector of the financial sector.
I guess we'll get into more details of this when
Radhika
comes into this.
Now we come to the overall picture and our forecast. So overall, we'll see that the growth trajectory of the Indian economy has come back to the high growth path that was there till 2017-18 before the slowdown of growth started. One thing to note here is that the India in the last financial year, it grew at a rate of 8.2%. Whereas we have seen that the GVA, the gross value added, grown at a rate of 7.2%. So there is a 1% difference, so which shows that there is a high tax buoyancy, because there is a net taxes are increasing at a robust rate. So our growth forecast lie in the range of 6.9% to 7.1% for the financial year of 24-25. This the 6.9 forecast that comes from. So we have two alternative forecast models. One is based on high frequency indicators. It's a quarterly model. So where we extract information from around 18 to 29 high frequency indicators, and we forecast growth rate for 4 quarters, and then we average them, weighted average, to get the annual average of the year. The second model, NIPFPA, which says that the growth rate is going to be 7.1%, a little bit higher side compared to the quarterly model. Is based on annual frequency indicators and based on a set of demand and supply side factors. So we presume that the pickup, we have also seen that there is a private investment growth has picked up, and investment growth is recovering. So these two are going to drive the growth momentum in the next few quarters. However, the downward risk is the further decline in net exports due to oil price shock has come into the crude oil market. So that's
move on to inflation now.
Yeah. So from growth, now we come to the story of inflation. So the headline inflation was below the target level of 4% till August, owing to the low declining and low growth rate of all the components, food, core, and energy. However, in September, there is a sudden rebound and surge in food inflation to 9.2%, which has also picked up the headline inflation to 5.5%. Core inflation also, which was declining till June, we see that it has started now flattened and then started increasing, mainly due to the rebound of gold and silver prices. Energy prices are still in the negative domain, but energy inflation are still in the negative domain, but it's again showing a rebound. So this rebound is actually the effect of the oil price shock happened a few months earlier, and that is with a late that happened in the last year. So that is in a late transmission that we are seeing in the Indian energy inflation. So so our forecast. So our inflation forecast for the coming 2 quarters at 4.2% and 3.8% respectively. The annual average inflation forecast is 4.3%, which is close to RBI's annual forecast of 4.5%. However, the surge in food inflation and core inflation may pose upward risk to the inflation trajectory in the economy in the coming quarters. So,
You go on with employment, that's all should be.
so with next we have a look on into the employment scenario. We see that there is a gradual improvement in the labor force participation rate and working population ratio for both male and females. There's a little bit stagnation during the COVID, but there is not actually a dip that we would expect that to see during a shock like pandemic like shock. There's a lot of debate has going around, and the underlying factor would be that there has been a lot of reverse migration from the cities to the rural areas, and there is a MGNREGA allocation increased, which actually to absorb those reverse migrated people, and that actually stabilized the LFPR and WPR. So these are on the annual. These are based on the PLFS data annual for both rural and urban. Now to see what is the current scenario, we look at.
No, just same. Your first discussion was on the slide on the left side. Now you're moving to the slide on the right side.
Here both the first is the LFPR, the left side, the right side is the WPR, both showing a similar pattern, gradual improvement in over the years. However, if we come to the recent picture, based on the quarterly frequency of PLFS, which counts only for the urban population. So that shows that there is a slight, the male LFPR and WPR showing in the blue bars in both the left and right panels are increasing, where has increased from the last quarter.
For those who are not familiar, just for conceptual clarity, the labor force participation rate means people who are available for work, either they're already employed or unemployed, underemployed, whatever. Whereas the worker population ratio is actually showing what percentage of the workforce is actually working. So it's also called the employment rate. Sorry, please carry on.
Yeah, so we see that compared to the last quarter of, so January-March quarter of 2024, compared to that, in April-June quarter of this year, there is a rise in the male LFPR and employment rate. However, we see the opposite trend for the female employment rate and LFPR. So this kind of covers our domestic front of the economy.
So we move now from the real sector and the domestic economy to the external sector, Radhika.
Okay, so on the external sector, we are looking firstly at the monthly trade data. We are looking at exports and imports. So in the month of July and August, goods exports contracted. In September, there was a marginal pickup, but it was around 0.5% growth, year-on-year growth in September. In August, the key highlight was that imports grew at a very sharp pace, mainly due to increase in gold imports. And gold imports increased due to the reduction in duties that was announced during the budget that resulted in a surge in gold imports during August. And in September, we see some normalization in gold imports, and therefore import growth overall also moderated in September at 1.6%. As a combination of both these factors, overall trade deficit improved because exports picked up and imports grew, but at a slower pace as compared to August. Therefore, there is a slight pickup in, there is a slight improvement in trade deficit, which is the red line in the first graph. So the first graph is telling us the picture on the goods trade front. The green are the goods exports bar, yellow are the goods imports, and the red line is the trade balance. So that shows a improvement. Services trade is continuing to grow at a encouraging pace. In the month of September, services exports posted a growth of 7.7%, and the trade surplus was $14.3 billion. Encouragingly, what we are seeing is that, if we look at the composition and the drivers of exports, if we exclude oil and if we exclude gems and jewelry, if these two components are excluded, overall exports are not doing that bad. Overall exports are growing at around 9%. They grew at 9% in September. So the key reason for the decline in exports or the weak growth in exports is also the reduction in oil prices in September that resulted in reduction in oil exports. So that was one reason. And gems and jewelry exports have been contracting. That has been a pain point for quite some time due to reduction in global demand, because the main importers of gems and jewelry are the US and other advanced economies, and because they are facing uncertainty and subdued demand, so gems and jewelry exports has not been doing well. But on the other side, components like engineering goods, electronic goods, these have been doing well. So we see a mixed picture on exports. Services exports have been doing well, which is also reflected in the balance of payments data. And overall, if we look at the first half of the current financial year, India's exports, which includes both goods and services, grew at a 4.9% growth, while imports, again, goods plus services, grew at 6.9%. So that's the picture on the trade front.
Still not working.
So now we come to the balance of payments position. We have the data till April to June quarter. So first we look at the current account balance. So the key highlight is that the current account balance turned negative in the April to June quarter from a surplus in January to March quarter. So in January to March quarter, the current account balance was surplus at 0.5% of GDP. In April to June quarter, it turned negative at 1.1%. And the main reason was that the net flows or the deficit under the goods trade that widened further in the April to June quarter. And the underlying reason for that was the increase in oil prices. So that was the main reason why the merchandise trade deficit widened, and that resulted in an increase in the current account deficit. On the other hand, the surplus on the services trade improved, and that is mainly due to improvement in software services. Secondary income is the blue bar, which mainly accounts for remittances, and there also we see an improvement. So overall, there are two factors that are pulling the current account balance into the negative direction, which is the goods trade balance and the primary income, whereas services trade and secondary income, mainly comprising of remittances, is giving it an upward push. And overall, the combination of this has resulted in a current account deficit of 1.1% in April to June quarter. Overall, if we look for the current financial year,
to the right-hand side.
yes, the current account deficit is as a percent of GDP is showing on the right side, where we are seeing a 1.1% that is negative. So overall, if we see around, so again in July, September quarter, oil prices were down, but in the October month, oil prices have risen. So current account balance is expected to be in the range of 1 to 1.2% for the full financial year. Now we come to the financial account. The financial account mainly comprises of the various investments and the reserve assets. And here, what we see is that in April to June quarter, the key highlight was the contraction in, was a sharp slowdown in portfolio flows. Due to global uncertainty, portfolio investments are shown as the green bar. So we see a decline in portfolio investments. So this graph is showing the net financial flows, which is the black line, and it's showing the various components of the financial account, which are also expressed in net terms. That is, it is the difference between inflows and outflows. So overall, if we look at the green bar, it's the portfolio investments, which exhibited a decline in the April to June quarter as compared to the previous quarter. On the other hand, on the positive front, there was an improvement in direct investment. If we see the red bar, there is an improvement in the direct investment. The yellow bar mainly includes external commercial borrowings and NRI deposits. So in the April to June quarter, the component that led to increase in the net flows was external commercial borrowing, mainly the trade credit, which is the short-term lending and borrowing for trade purposes. So that resulted in an increase in the yellow bar, which is the other investments. The other key highlight is the reserve assets. So reserve asset was, it shows the net change in the stock of the RBI's assets, and it was negative, but that negative improved in the April to June quarter, and that is mainly because there was an accumulation of foreign exchange reserves in the April to June quarter to the tune of $6 billion from the start of the quarter to the end of the quarter. So that was the main reason why the negative shrank, and there was a movement towards positive, that is improvement in the net accumulation of RBI's assets. If we look at the reserves and the exchange rate position, the first bar, the first graph is showing us the total foreign exchange reserves, and total foreign exchange reserves by the end of September grew at a, crossed $700 billion. And there was a lot of debate and discussion around whether this is good or bad, and why we are seeing a sharp rise in the RBI's foreign exchange reserves. There were two reasons. One, due to the RBI's intervention to prevent rupee from strengthening at a sharp pace, that resulted in accumulation of dollars, and therefore the foreign exchange reserves rose. And second was also revaluation, because the reserves are held in the form of US denominated assets. So when the US yields show a decline, what we are holding, that will revalue. So that will be a revaluation gain. So overall, these two factors resulted in an improvement in RBI's forex reserves, and they crossed $700 billion. Though in the month of October, again, we are seeing a dip, and because now RBI is intervening on the other side. That means it is selling dollars to prevent rupee from depreciating. Therefore, we are seeing that the reserves have slightly fallen, but it's still above, it's around $690 billion. The outcome of all this is that if we look at the rupee dollar rate, which is the orange line, it has exhibited stability. We don't see much of a movement, and that means that the RBI has been extensively managing the rupee dollar rate. It is not allowing the rupee dollar rate to fluctuate much. And that is also visible if you look at the second graph, which shows the actual purchase and sales of foreign exchange reserves. The blue bar shows the purchase, and the red bar shows the sales. So we are seeing that there is active intervention, and this is only spot market. There is also intervention in the forwards market, and that is resulting in an increase, that is resulting in a decline in the annualized volatility of the rupee dollar rate. So that is the picture if we look from the rupee dollar rate front, that the rupee has been moving in a comparative perspective. Also, it's been moving in a very narrow range, thanks to the active intervention by the RBI, and that has resulted in accumulation of foreign exchange reserves.
And also, if you look at the real effective exchange rate,
Yes.
they've also been pretty flat, not as much as the nominal.
Right.
But of late, there's been slight depreciation.
Slight depreciation.
In the
yes.
real effective exchange rate.
Absolutely, sir.
Please carry on.
Yeah, so now we come to monetary policy and financial markets. So if we look at the monetary policy stance and the policy rate, we saw from May 2022 to February 2023, the RBI raised the repo rate by 250 basis points, and the repo rate was 6.5%. It still continues to be 6.5%. So since February 2023, there has been a status quo on the policy rate. But if we look at the stance in June 2022, the stance was also changed from accommodation to withdrawal of accommodation, because in May the policy rate started rising. So concomitantly, the stance was also changed to withdrawal of accommodation in June 2022. And in the recent meeting with the reconstituted Monetary Policy Committee, the stance was changed to neutral, but the policy rate continues to remain stable at 6.5%. So the changing of stance to neutral accords flexibility going forward, that there could be an increase or decrease in rate. So that is a kind of forward guidance being given through the neutral stance that has been changed from withdrawal of accommodation. As a result, what we see is that the short-term rates have eased, and if you look at the graph, the black line shows the repo rate, which has remained stable at 6.5%. 91-day T-bill has come down, and call rate, which is the operating target of monetary policy, is hovering around the policy rate. So that is the picture on the money market front. The short-term rates are suggesting that they are closely following the trajectory of the repo rate. Government bond yields, we are seeing a very interesting picture that there is a convergence of yields across all tenors, be it 1 year, 3 year, 5 year, or 10 year. There has been a easing of the government bond yields, and there are a variety of reasons for the easing of yields. The key reason has been the positive sentiment due to government bonds being included, Indian sovereign bonds being included in the emerging market bond index, starting with the JP Morgan bond index, and now even the FTSE Russell bond index has included the Indian sovereign bonds, decided to include. So that is that has resulted in an increase in demand for Indian government bonds, and therefore a reduction in yields. However, the rising crude oil prices and the increase in the US 10-year bonds could pose an upside risks, because normally what we see is that the Indian 10-year bond yield is mirroring the US 10-year bond yield. So there was a time, because after the US Fed rate cut, the US 10-year bond yield also fell, but because the US economy continues to be strong, again it's rising, and that could have an implication for the 10-year bond yields also going forward. Corporate bond yields, overall, they are mirroring the trends in the government bond yields. We are seeing that the longer tenor yields are showing a greater easing as compared to the 1-year bond yield. So the 1-year bond yield is higher than the 5-year and the 10-year bond yield. And the main reason for that is that there is a greater demand for medium-term and long-term corporate bonds, mainly coming from the institutional investors, such as insurance companies. And the other key, dynamic change that has happened over the last couple of months is that since RBI imposed restrictions on bank lending to NBFCs because of the increase in risk weights that was announced in November last year, since then we are seeing that NBFCs are also greatly tapping the corporate bond market. So there is a greater demand as well as greater supply of bonds happening in the corporate bond market. Banks are issuing bonds, AT1 bonds, NBFCs are issuing, companies are issuing. So there is a great churn happening at the current moment, and there's great activity happening in the corporate bond market. So that's a very interesting phase, because till now we were seeing corporate bond market to be quite tepid, but now it's picking up, and one reason for that is that because of the restrictions imposed by RBI on NBFCs borrowing from banks. On the liquidity front, so just conceptually, the negative bars shows surplus liquidity overall, because if we just click on the yes. So overall system liquidity in the banking system is depends on the net borrowing under liquidity adjustment facility and the excess reserves maintained by bank. So if the banks what the banks are borrowing, they can borrow through repo transactions or through marginal standing facility. If that borrowing is more than the deposits that they are holding with the RBI, then there will be a liquidity deficit. That means there is greater demand for funds, so that will result in increase in banking sector liquidity deficit. However, if banks are already surplus funds that they are keeping more reserves with RBI, that will result in liquidity surplus. So that's just for conceptual understanding, and we can go back to the. So here we are seeing that currently there is banking system liquidity, though the liquidity is now, the surplus liquidity is declining as compared to the August-September period. But overall, again, it continues to be, overall banking system continues to be in liquidity surplus. And this is because RBI keeps conducting both the VRRR and VRR auction, that is variable reverse repo auctions and variable repo auction, to modulate liquidity and to ensure that the call rate remains closer to the policy rate. So that is the reason why we are seeing this is the daily data. If the right side shows the daily time series data of call rate and the red bar shows the repo rate. So we see that it is around the repo rate. The call rate is around the repo rate. Next slide. So this is the picture on the banking credit growth. Last time when we discussed, we saw that the banking credit was growing at a robust pace of around 15 to 16%. And the main reasons for that was a sharp increase in personal loans and loans to services. And now that picture seems to be changing again due to
services mainly really are non-bank.
Non-bank. Yeah, non-food.
Non-food credit.
Yeah.
I mean, the services, actually what it means is really NBFC, non-bank finance companies.
Yes, sir. So those personal loans and services, mainly including bank loans to NBFCs, were the two key drivers of the sharp growth in bank credit, which is the black line. And in the last financial stability report, also we saw that the RBI was concerned with the increase in unsecured retail loans and increase in bank lending to NBFCs, and therefore we saw that the RBI increased the risk weights in November 2023, and its impact is visible now. From May we are seeing, if you look at the personal loans, which is the yellow bar, we see that there is a sharp decline in the growth rate of personal loan. There's also a decline in the loans to services, and therefore overall non-food bank credit is showing a moderation. At that time, the narrative was also that the credit deposit gap was widening because credit growth was rising as a sharp pace and deposits were not growing, deposits were not picking up. But now that picture seems to be changing. If you look at the right side graph, we have credit growth including HDFC merger and excluding HDFC merger impact. It's very important to see both because excluding HDFC merger is more comparable because you can compare with the data before the merger happened. So therefore that is the red line. So what we see is that, and the blue line is the deposit growth, we see that the gap is narrowing. So there was a time when the gap was quite high, and that gap seems to be narrowing. And even as recent as the beginning of the year, RBI was concerned with the rising credit deposit ratio. It was rising to around 80%. Again, that seems to be cooling because of the moderation in credit growth. Last, we come to the capital market position. This is the right side we'll take up first, which is the FPI net investment. In June, the FPI, the foreign portfolio investors, were net sellers mainly due to election-related uncertainty, but they bounced back. And in the month of July, August, September, we saw that FPIs were net buyers of both equity and debt. And that was, again, mainly driven by FPI investments in debt because of the inclusion of Indian sovereign bonds in the EM bond index. September was a great month. FPI's in net investment rose sharply to almost $11 billion. But again, in October, the picture has changed sharply, and now there is a concern that FPI net investment outflows may cross $10 billion. Mainly because of a confluence of the geopolitical conflict, the rise in oil prices, but more importantly, the stimulus that has been announced by China. So we saw in the month of October, China announced a stimulus package to support the economy, mainly in the form of cut in reserve requirements, encouraging banks to lend more and also providing some support to the capital market in China. So as a result, we see a reallocation of funds from emerging markets, including India, towards China, and that has resulted in a sharp slide in FPI net investment, though domestic investors continue to support the market. And if we look at the market picture, which is the Nifty 50 market return, we don't see that discouraging.
To the left-hand side.
Yeah, the left side, that we don't see such a discouraging picture because some support is being provided by the domestic institutional investors.
Okay, so that brings us to the end of the monetary policy and financial markets segment. Now we move on to the last main segment, that is fiscal outlook of central and state governments, which Manish will walk us through. Manish.
So let's look at the central government finances first. So you find that all central taxes are buoyant except corporation tax and excise duty. So compared to last year, between April and August, we find a decline in corporation tax. But as per the latest data available, provisional numbers till 11th October, we find that corporation tax has registered a robust growth. So not much to worry about on that front. Gross tax revenue grew at 12% during April-August 24. Income tax growth was 25%. Custom duties grew by 13%, and central GST growth was 10.4% due to continuing momentum of economic activity. In the 24-25 budget, gross tax revenue growth target was set at a modest 11.7%, and whereas the nominal GDP growth was projected to grow at 10.5%.
Before you go on, do you want to say anything about why these two components, corporation tax and excise duties, have not been buoyant?
No, corporation tax initially, because a large part of this decline is on account of refunds which were large compared to last year, more than 30% increase in refunds during that period. But going forward, as per the latest data provisional numbers which Ministry of Finance posted, till 11th October, we find around a robust growth in corporate
Corporate tax is also buoyant.
Corporation tax is also buoyant. So we were
except the excise duty, everything else is buoyant.
Excise duty, everything else is buoyant. On the non-tax revenue, the growth.
Why is excise duty not doing well? Any views?
Cut in the rates and which and it's been excise duties have been low for quite some time actually, and there has been a fall in union excise duties.
Mainly due to rate reduction.
Mainly due to rate reduction. And on the non-tax revenue front, non-tax revenue growth is very high at 59, close to 60%, mainly due to enhanced dividends from RBI, and in the budget, non-tax revenue is budgeted to grow by 45%. So overall is the central taxes are buoyant, and going forward they are expected to remain so. On the expenditure front, we find that total expenditure, so on the top graph, you see the levels of different components of expenditure, revenue expenditure, capex, capital expenditure, subsidies, and total expenditure. So total expenditure growth, which is the yellow bar, is negative due to sharp compression in capital expenditure, and revenue expenditure growth has been modest. So you find that the capital expenditure declined from 3.7 trillion to 3. Revenue expenditure growth was moderate, and as a result, the overall total expenditure, there was a fall. As far as major food subsidies, that is subsidies on food, fertilizer, and petroleum, there is not much change there. Capital expenditure fell by 19.5% during April-August 24, largely due to election code of conduct. So, but here also, if you look at the numbers of August only, we find that post-elections, there has been an uptick in capital expenditure. So capital expenditure is picking up. It's just because of the elections that you find there was a contraction, and in going forward in the second half, we expect it to increase. So for 24-25, capex is budgeted to increase by 17%, and however but the increase in revenue expenditure budgeted is a modest 5%. Major subsidies are budgeted to decline in the 24-25 budget. So on the overall expenditure front, capex is expected to pick up, revenue growth moderated. Now we come look at the deficit numbers. 23-24 fiscal deficit target of 5.9% was met, attributed to buoyant revenues and moderate revenue expenditure growth. 24-25 FD target set at 4.9%, and which is in line with the FD reduction goal of 4.5% by 25-26, and it's likely to be met, we believe, because in the current budget, 11.1 trillion was what the government had budgeted the total capital expenditure would be, and in the first 5 months they could spend only 3 trillion. So in the next 7 months, unless the government spends very highly in every month to month, we don't expect much we don't expect them to achieve the target of 11.1 trillion. So it is a difficult target, given that we just have now 7 months time to increase our capital expenditure. So unless the government make enormous effort, we think that the target may not be met, but and which may have an impact on the fiscal deficit target being achieved comfortably in the fiscal year 24-25. Now let's look at the states in aggregate. So the left graph shows the total revenue receipt of the state governments. The orange bars is the own revenues, which is own tax revenue plus own non-tax revenue, and the green bars are the central transfers, devolution plus all central grants. So we find that on average, own revenues account for about 68% of the total revenue receipts, and the share of central transfers is 3.2. Between April, August 24-25, on average, total revenues grew by 5.5%, mainly due to increase in own revenues. And within the own...
Just because it's a very rich, dense graph.
Yes, sir.
Just explain that there's one bar there on both sides, which is actually all India average. And most of the picture is really the spread.
Spread, yes.
Large variations across states.
So, yes. So while we see that the own total revenue is growing at 5.5%, but then you see there is a huge variation across states. There are cases where the central states where there's been sharp decline in central transfers, even own revenues have declined, but then you have states which show a sharp increase in central transfers. So there's a huge variation, large variation in revenues, revenue growth during April, August 24, ranging from contraction to high growth. If you look at the right-hand graph, which shows the own tax revenues of the state, and although the overall average, all state average is 9%, but then there is a huge interstate variation ranging from a negative growth in Madhya Pradesh to about 16% in Nagaland, and the all states own tax revenue is budgeted to grow at 14.5% in 24-25, and implied buoyancy of greater than 1 if the nominal GDP is assumed to grow at 10.5% as is budgeted in the current budget, union budget. Now, let's look at what has happened to the transfers. So again, you see there is a huge variation across states, and that the all state central, if you look at the all state numbers, the central transfers grew by 1.4% only, but this is because of the robust growth in devolution was largely offset by decline in grants. You find that devolution, all state devolution increased by 18% on average, but then we see a contraction in Bihar, the only case. Grants also saw a decline in all states except 3, UP, Maharashtra, Karnataka, and you find a remarkably high growth in grants in Karnataka, and this could be because of the base effect of the elections which happened in Karnataka last year around May, June, and for fiscal year 24-25, all states combined budget indicate a 11% increase in devolution, but a 6% decline in grants. So grants in general has been declining. There's a declining grants, and more so after the GST compensation period got over. So the story is, in order to meet the requirements, commitment, the government, central government is basically giving 41% as devolution to compensate for that. There has been a general tendency of decline in grants, and even if you look at the central government budget on various CSS and all, the increase is not as high as compared to the GDP growth. So there has been a decline in grants. That is the general story. Now, if you look at the expenditure side, we find that capital expenditure contracted in most states. But again, there is a huge variation, large variation across states and this contraction of 6.7% all states contraction was despite 1.5 trillion 50-year interest-free capex loan provision from the central government, but till July only 15,000 crore could be released. That is also again because of election code of conduct, and for fiscal year 24-25, all states capex is budgeted to increase by a modest 5.6%. However, revenue expenditure, which accounts for about almost 90% of total expenditure of the states, grew by 11%, and that resulted in total expenditure growing by close to 9% on average. But then again, there are large variations. In 5 states, we see the orange one is the orange bars are the total expenditure, blue bars are revenue expenditure. So in 5 states, which are towards the left, you find total expenditure contracted, and this contraction was driven by capex contraction in those states. In Karnataka, which is on the rightmost bar, total expenditure show a growth of 36%. Revenue expenditure growth was 35, mainly because of base effect of expenditure contraction in 23. Revenue expenditures is also high in some of the states like Haryana, Bihar, and Tamil Nadu. So basically, it is the revenue expenditure growth which is driving the total expenditure in the states, and there is a contraction in capital expenditure at all, aggregating across all states. Now let's look at the deficit and debt numbers. So the blue left-hand side graph, the green line shows the revenue deficit. The orange is the fiscal deficit, and the dotted black line is what the 15th FC glide path for the fiscal deficit is there. So we find that all states combined fiscal deficit, which was around 2.8% of GDP, GSDP, increased to 3.5 in 23-24 RE, and in 24-25 it's budgeted to improve to 3.1%. The target is 3, so we are almost there, but it is still within the upper limit of the 15th FC target of 3.5. So the 15th FC gave a upper limit and the target and the glide path, and also an upper limit of the glide path. So states, although slightly out away from 3%, but then well within the upper limit of that. All states combined revenue deficit after deteriorating in 23-24 show an improvement to -2% in 24-25. Now we look at the right-hand graph, which shows the outstanding liabilities aggregated across all states. So you see a post-COVID decline in combined outstanding liabilities of all states to 28% in 22-23, but liabilities are projected at 28.3% of GSDP in 24-25, and again, the liabilities have been, all state liabilities have been well below the 15th FC path, but there is a huge variation across states, both in terms of fiscal deficit and the revenue deficit. So you can see the left-hand graph, which shows fiscal deficit of states. It ranges from 1.9% for Gujarat to 4.6% in case of Himachal. And if you look at the outstanding liabilities, Odisha had a 10% liabilities, whereas Punjab, which has the highest outstanding liabilities of around 46.6, and the blue lines are for the all states. So you can see there is huge variation on although in aggregate states are well within the FC target, but individually there are states which are much higher than what 15th FC had recommended. 15th FC all state recommended path is. So there are issues in case of certain states, but in general, all states we find a more comfortable position. Now, aggregating center and states, we find that the combined fiscal deficit of center and state is budgeted at 8% of GDP, whereas for 24-25, whereas the 15th FC path says target is 7.3%. But then you see the orange line is moving towards the 15th FC path. So you have from 9.4% FD in 21-22, we see the combined, there's a consolidation, continuing center states together are consolidating, but we are still below the 15th FC target Centre's fiscal consolidation, as I had said, was largely driven by buoyant tax revenues. Central government on track of achieving fiscal deficit less than 4.5% in 25-26. And if you look at the states, after diverging from 15th FC recommendation in 23-24, states combined fiscal consolidation is back on track. State liabilities at 27.4% of GDP. Center's liability, which is 55.7% of GDP, and the combined liabilities of center plus state at 80.2% of GDP in 24-25 is within the 15th FC prescription of 13.9 for the states, 58.6 for the center, and 80.2 for the combined. So we find that combined fiscal consolidation of center plus states continues actually. And the table shows the breakup of fiscal deficit. So states fiscal deficit hovering around 2.6 to 3%, whereas center's fiscal deficit is on a higher trajectory, is much higher, but center is consolidating and likely to achieve 4.5% in the coming year. So,
thank you, Manish. So that was a long presentation of all the components, as Professor Rao mentioned at the outset. Very comprehensive and also covering in depth. So it's a lot to digest. So what I'm going to do now is just for each component, just make some, highlight the main takeaways, at least as I see them, just to summarize the whole picture as concisely as possible for the different components. So starting with the growth and inflation part, which Rudrani covered, so we are now forecasting a 7% growth for 24-25, which is on top of a growth rate of 7% and 8.2% in the last two financial years. So, and this is despite, the very adverse global conditions which Radhika summarized for us. Despite all that, the economy seems now to be back on that high growth path of 7 to 8%, which had been achieved before the trend growth started declining in the fiscal year 17-18. As Rudrani showed in the first quarter of this fiscal, there has been some moderation in growth, and this was partly due to a sharp contraction in net exports, that is exports minus imports, and also in government consumption expenditure, as has been discussed, because of the restrictions of the election code of conduct. On the supply side, tepid growth in tourism, travel, and financial services was mentioned. If you look at the high frequency data index of industrial production, the latest August numbers show slowdown across the board in construction, capital goods, consumer durables, and contraction mining and electricity. Now, whether this is just a one data point or whether this will persist remains to be seen. On the inflation side, it fell below the 4% RBI target in August, but it rose again in September to 5.5%, still within the RBI's tolerance band ceiling of 6%. And this is mainly happening because of high food price inflation. So our annual forecast is 4.3% for the year as a whole, which is very close to the RBI's forecast of 4.5%. But nevertheless, there are some important risk factors which may drive inflation up, mainly the persistence of high food price inflation. And it's also possible that core inflation might rebound. Moving on to Rudrani's presentation on the employment side, the annual PLFS data, and this is, I should clarify, all based on the current weekly status data, not the usual status data. That shows a gradual rise in both LFPR, that is the labor force participation rate for men and women, persisting since that should be 17, the typo there, 2017-18. And the overall labor force participation rate, that is combined for men and women, rose from a little over 48% in 2017-18 to as much as 56% plus in 23-24. Similar rise in the employment rate, as I explained earlier, the WPR, or the worker population ratio, is the employment rate for both men and women, has also been improving since 17-18, with the combined WPR rising from over 44% to close to 59% at present. That is the latest PLFS survey that came out. Looking at the higher frequency numbers, which you only get for the urban sector in PLFS, because the agricultural season doesn't allow you to do this for rural areas on a quarterly basis. And the PLFS data shows improvement in both labor force participation rate and the worker population rate for men, but a mild decline in the female labor force participation rate and the worker population rate in April-June 2024. Before I leave the employment picture, I should clarify, as Rudani mentioned, why you don't see a dip in the LFPR during the pandemic and so on. There has been some controversy about the data, but also there's a lot of detail in this. If you drill deep into it, different categories, the corporate employment, regular workers, self-employment, casual labor, etc., which we have not had time to go into. So it's a complex, the employment dynamics is a very complex picture, and we are really giving, if you will, the tip of the iceberg here. Moving on to the external sector, as Radhika mentioned, merchandise export growth fell and the deficit rose mainly due to geopolitical disruption and reduced global demand. The merchandise trade deficit more than offset the fairly substantial surplus on the services side. As a result, there was a rise in the overall trade deficit. Coming to financial flows, what we used to call the capital account earlier, that shows monthly net inflow of roughly, this is a ballpark thing, of around 10 billion till June, monthly inflows, but a net outflow happened in March of $5 billion. Now, there's been, as she was explaining, sustained increase in foreign exchange reserves has gone up to over 700 billion by September 2024. Despite this, you would expect that with that rise, we'll get some appreciation in exchange rate, but that has not happened. The rupee-dollar exchange rate has remained stable, and actually the real effective exchange rate showing a mild, it's also pretty flat, but a mild depreciation in September, and the volatility, as she was explaining, has come down very significantly. All of this is really attributable to very active intervention by the Reserve Bank in the same month. Sometimes it's buying, sometimes it's selling, and so on. And it seems to have been a very well managed operation. Moving on to monetary policy and financial markets. As again, as Radhika mentioned, the accommodation stance was withdrawn in June of 2022. It was combined with a 250-point repo rate increase between up to 6.5% now between March 22 and March 23. May 22 and March 23. I think, Pami, this was a period when you were part of the Monetary Policy Committee, right? So really have a more discussion on this when you speak. So the latest October MPC meeting, the repo rate has been retained, no change, but the stance has been changed from withdrawal of accommodation to neutral. And that makes a lot of difference in the kind of signals that RBI is giving out. And as Radhika mentioned, the sovereign bond yield curves across maturities has flattened. They've all come together, whether it's the 91-day Treasury bill or the call money rate, not the call money, the 91-day Treasury bill going up to 10-year, the benchmark. They're all around in the same level, a little below 7% is where they have settled. the private sector corporate bond yield, obviously there's a risk element here now, which is not then sovereign bonds. So that has also flattened and settled, but at a little higher, just under 8%. If you move to the credit picture, the non-food credit growth has slowed in recent months, as she was mentioning, and that has reduced what has been causing a lot of worry about the credit deposit gap. So now the credit deposit gap is reduced. And this is mainly due to reduced lending for personal loans and services. As I was mentioning, services really should read as non-bank financial companies, their services. And this is ridden, as was mentioned, by the increase in the risk weight attached to lending to these two components, personal loans and services by the RBI. Going to the capital market, there was a very buoyant rise in stock prices. For about 4 months, people have begun to worry about whether there's some bubble building up and so on. This is mainly driven by very active purchases by foreign portfolio investors. But that declined in October, the stock prices, with FPI withdrawing from the Indian market. And as was mentioned, this is driven by the ongoing 2 wars, which is causing a lot of uncertainty, possible expectations of a hike in oil price rise, and mainly, of course, the China stimulus that was mentioned. How that is playing out in China, we have yet to see, but my sense is that actually it has not really worked. The Chinese growth has not really recovered. But we are not getting into that. Coming to finally the fiscal outlook, central tax revenues buoyant except for excise and corporation tax, as Manish mentioned. But despite that, the Finance Ministry has been very prudent, and they've made revenue projections growing at only 11.7%, which would be lower than the nominal growth rate or around the same for 24-25 in the budget. But very high non-tax revenue growth projection of 45%, because as we all know, the RBI's dividends given to the government was very large. So the projection is 45% there. Capital expenditure and revenue expenditure, mainly subsidies, was compressed during April-August 2024 because of the election code of conduct, as we mentioned. But capex is now projected to grow at 17% in the budget, while revenue expenditure is only projected to grow by 5%. And this pattern of strong fiscal prudence combined with large expenditure on capex, very compressed expenditure on revenue, has become a kind of signature of the finance minister. This is a 6th budget, and all of them have retained have had this feature. So the budget deficit is proposed to be brought down to 4.9%, and this is, as Manish mentioned, likely to be met. And this is en route to getting to her, again, she announced 3 years ago that she would hit a target of 4.5% by 25-26. Coming now to the states picture, very complex picture with large variations across states in almost all aspects of state finances. But taking the overall average picture, revenue are projected to grow at 7.5%, mainly on account of the own tax revenue, not transfers. Even though there are large flow to the states by way of devolution, the grants are being compressed. So the net transfers is actually very, very modest. So it's mainly the own revenues, mainly own tax revenues, which account for the growth of states' total revenues. On the expenditure side, the composition actually is quite weak. As Manish mentioned, capital expenditure actually contracted by 6.7%, while revenue expenditure, which accounts for the bulk of it, 90% of total, is growing by 11%. So for the all states, fiscal deficit is projected to come down to 3.1%, which is pretty close to the 3% target. and the debt GDP ratio or the ratio of liabilities, outstanding liability to GSDP at 20%, which is well below the recommended target by the 15th Finance Commission. Finally, coming to the debt position, this is really now the main issue. This is the finance ministry now beginning to look at debt GDP ratio as the anchor on which to organize fiscal policy. Now there, the GDP ratio of states is 27.4%, center 55.7%, and overall 80.2%. All of these are compliant with the targets which have been set by the 15th Finance Commission, which is 30.9% for states, 58.6% for center, and combined 80.2%.
87.8.
Oh, sorry, there's a typo.
87.8.
Yeah, okay. Okay, so we are well within that. Yes. So that's it. Thank you very much. And there are additional information they have, which is all in the appendix and so on. If the discussion is necessary, we will go into it. So now.
Thank you very much. Long, pretty extensive, exhaustive presentations by all of us, all of you. I shouldn't claim any share in that. But we'd now like to request Professor Pamidua to share her thoughts on the economy and on, can you share the mic?
Thank you very much also for having me here today, and I apologize for the few minutes delay in reaching here. So I think we've all seen a lot of numbers, and it was a very thorough report, very insightful, and I'm happy to see that each sector has been analyzed in great detail. So I thought that I won't get into numbers again, because I think we need to see where we are and where we have to go and how we will get there and what are the challenges that we face in getting there, and that might help to give more insight into the data. So I thought I'll start by answering the questions like, what is the vision we have for the Indian economy, and what are the global challenges that the Indian economy faces, or that the entire world faces right now. And the most important thing is that, okay, we know where we want to get, but how do we get there? How can India make itself resilient, or is it already resilient to all the external shocks, given the analysis that you have made here? And that this exercise can be done for each sector or each factor, which gives us an indicator of resilience, and I'll get into that a little bit. So where we want to go, where we are headed, is the Viksit Bharat vision that has been given to us, and that is that India has embarked on a journey to become a developed nation, and this strategy aims to propel India into an era of economic prosperity, social progress, and environmental sustainability. And as the world's most populous country and one of its fastest growing economies, India's trajectory holds significant implications for the global economy as well. So what does the Viksit Bharat vision imply? So it implies the creation of, first of all, world-class infrastructure, and then ensuring energy security, expanding digital public infrastructure, promoting digitalization, enhancing financial inclusion, and tackling climate change. So these are few of the factors that are given in the vision. And basically, each of these elements is not separate. These are all interconnected. And the idea is to provide a robust foundation for sustained growth and innovation. And the aim is to make India a $30 trillion economy by 2047, and also to increase per capita income and improve the living standards. So this would require an average GDP growth of approximately 10% per annum. And given your forecasts and also what we have seen in the past, so we are in the area of 7 and 8%. So, and also you did a lot of analysis on the state's performance, and as part of Viksit Bharat, the government has proposed interest-free loans to the state governments to enhance the infrastructure and also give additional resource allocation and initiatives for all-round development of the weaker parts of the country. So that is one thing. And the second question that I had posed was that what are the global economic challenges, and is India resilient to these challenges or the shocks that we are witnessing? And right now, we know that the global economic landscape is fraught with a number of challenges, and these include climate change, volatile energy markets, particularly if we look at oil prices. Then we have geopolitical tensions. Now, that we cannot control from an economic or financial perspective, but those are things that affect the economy a great deal, and they create uncertainty and also disruptions to international trade and cooperation, which we have witnessed with the exports. And then we have the supply chain disruptions, and also we still have some impact from the COVID-19 pandemic. And we also have seen more recently an increase in cross-border restrictions, and that affects the external sector a great deal. So all of these factors, they affect global production and distribution, and therefore pose significant risks to India's growth trajectory. Now, the IMF recently, just 3 days ago, released its World Economic Outlook, and they have projected global growth to be 3.2% in 2025, which is slightly lower than the pre-pandemic growth rate. And what is heartening, of course, is that India's growth rate is higher than the global growth rate and has been consistently for many years according to the IMF projections and also the actuals. And so IMF's forecast for India for 2024-25 is 6.5%. And if I look at the World Bank forecast for global, it's 2.7%. So it's more pessimistic than IMF of 3.2%, but India it's 6.7%. And then the forecast given in the economic survey were 6.5 to 7%, and RBI recently has given it as 7.2%, and your own forecast NIPFP is 6.9 to 7.1%. So basically, we are hovering around 7%, let us say. And that's what we have to take as our benchmark. So, can India stay at this 7% growth rate? That's the question, given all the data we have analyzed. And so, we have to see what is economic resilience of the Indian economy. So, what is the meaning of resilience? So, it is the ability of an economy to withstand shocks and recover quickly from these shocks. And basically, it refers to the ability to revert back to growth in the aftermath of these shocks. And these shocks include various challenges that I have discussed, and these include supply chain disruptions, climate shocks, geopolitical disturbances, and shocks emanating from commodity and energy prices, as well as financial market disturbances, just to give you a few of these shocks. So how do we measure how Indian economy has performed to these shocks? So I have divided the resilience indicators into three categories. So one I have said is domestic factors, second is external factors, and the third is the policy space that we have. So if we first policy, yeah. So the first one, which is domestic factors, so for that I have taken indicators which capture the growth momentum in the economy. So these would include economic growth rate, investment climate, stability of prices, stability of the financial system, exposure to climate related risks, and technology. So any external shock is likely to slow down the growth in the economy. So are these indicators robust for the Indian economy? So what we have to see is that if the fundamentals are strong, for instance, if there is robust domestic demand and if the financials are stable, then the economy will be able to withstand the crisis and bounce back to its growth trajectory faster. So that is one thing. So we have to see if we were able to do that. Then we have climate related risks, which pose now a huge challenge to the growth process. And how much is it possible to quantify whether we have become resilient? I don't think we have become resilient because climate change has increased the supply shock, the nature of the supply shocks that the Indian economy is also subjected to. Then what we have also seen is technological innovations, such as we have artificial intelligence. So how has that affected the economy? And that could have a positive or a negative impact. And it could be growth augmenting, that it could increase labor productivity, but at the same time, it may also lead to higher unemployment. So we have to see where we stand with respect to technology and artificial intelligence. Then if we look at the external sector, so the external sector being affected by the external shocks. So the ability of the economy to withstand external shocks impinges upon its capability to tackle the possible vulnerabilities that exist via the trade and financial channels, because if we are integrated with the rest of the world, then the maximum impact comes through the financial and the trade channels. So how strong is the Indian economy? And that you have shown that it has affected the trade, it has affected FPIs. So, so these indicators for the external sector would include dependence of the economy on exports as a channel of growth, then stability of exchange rate, then it would be stability of FDI flows to the economy vis-a-vis the FII flows, because we have to take them separately. And then we have the adequacy of existing foreign exchange reserves. So, in fact, most of your analysis suggests that India is quite resilient to the external shocks. So you may just want to note that this is like an indicator also of resilience. Then if you look at the policy headroom, so like how much policy space do we have to mitigate the external shock? And what have we done about the policy space? And so I've looked at fiscal policy and monetary policy, and what the government has done in terms of both of these in brief, which you have done in detail anyway. And just if you look at the budget for 24-25, then the budget indicated a significant increase in capital expenditure. Now the budget is also towards the vision of the economy. So to fulfill the goals of the vision, but to fulfill the goals of the vision, the economy should also be resilient. So the budget had a significant increase in capex, and there was focus on infrastructure projects like railways, roads, renewable energy. Then the budget also announced measures to promote digitalization, digital infrastructure, incentives for startups, then also healthcare, education, and rural development. So those were social welfare programs. Now, at the same time, there was also mention of fiscal consolidation, which you have also discussed here. And to attain a level of fiscal deficit lower than 4.5% of GDP by 2025-26, which you have also shown here. And also for 24-25, the fiscal deficit has been pegged at 4.9% of GDP, and which was 5.6% in 23-24. So there is an improvement over time in that. So we have to see whether fiscal policy is providing us that resilience or that direction towards the vision with the resilience to achieve it. Now, the second is monetary policy. Now, monetary policy, of course, in India, we have monetary policy committee which fixes the policy rate, and the aim is to control inflation, maintain price stability, keeping in mind the objective of growth. So actually, it's not just price stability, it is keeping in mind the objective of growth. And that's why we call it flexible inflation targeting, whereas many countries have inflation targeting. But we have here two goals, and both have to be balanced. And sometimes these are misunderstood. And the other thing about monetary policy is, which is also often misunderstood, or I am more easy in interpreting the inflation target. Like the monetary policy does not say that you have to achieve 4%. So it says 4 plus minus 2%. And the whole reason for having this band, which is 2 on both sides, was to accommodate, I think, was to accommodate the volatility in food and energy prices. And therefore, one doesn't have to worry so much. If there's an oil price shock, one doesn't have to panic that we are away from 4%, because you have to be within that band. And this entire discussion of whether we should have headline inflation or core inflation, actually, it just boils down to headline inflation. The band already includes the volatility. And if you remove food and energy, then you have removed more than 50% of the consumption basket. So in that sense, now, if you look at how monetary policy has behaved, now from May 2020 to April 2022, the policy rate was 4%. So for 2 years, it was kept at 4%. And that was to give a boost to the economy. And that was the pandemic period, the start of the pandemic period. So just after the start of the pandemic period, and much after the pandemic. And it was not lowered less than 4%. At some point, you have to think how low you want your interest rate and what would be the real interest rate. And more than that, is the interest rate giving you more investment spending? Is it making people spend more or not? And even with 4% during the pandemic, that was not happening. And that is why the Reserve Bank had to adopt unconventional monetary policy and also macroprudential measures to incentivize consumers and businesses to spend. And so it was kept at this level, 4%. And since May 22, it was raised in steps, and it reached 6.5% in February 23 and has remained at that level since then. Then the accommodative stance was introduced in August 2019. So it's not like everything fell apart in the pandemic. The economy was slowing down even before the pandemic. And so the accommodative stance was August 2019, and it continued till May 2022. And then after that, since June 2022, we have had the withdrawal of the accommodative stance. So that was a signal that, well, we may change the stance, we may not. So, and then it was changed to neutral in the October meeting, October 2024. So withdrawal was introduced in June 2022. So you can see that the monetary policy was proactive in providing the necessary support, and also the cut in interest rates was 250 basis points from May 2020. So before the cut in the interest rates to 4%, the interest rate in the economy was 6.5%. So we had 6.5%, then we went down for 2 years to 4%, then we went up again to 6.5, and we have stayed at 6.5 now since May 2022. And so this is how it has been managed. The other thing is that, has the interest rate trend followed the rest of the world? And to a large extent, the interest rate movements was synchronized during the pandemic period, and the magnitudes of changes were different, but direction was the same. Whether you look at advanced economies or emerging economies, everywhere in the world, except Russia may be an outlier because of the war. Japan is always an outlier, but apart from few of these economies, all others were moving together. And of course, with this drop in the interest rate in the US, everyone expects India also to move. But India has its own fundamentals also, so it has to weigh whether it wants to move to a lower interest rate, um, or also if it wants to lower interest rates by how much. So while the financial analysts say 50 basis points US, 50 basis points India, but it doesn't work like that. And that's the whole idea of taking this approach of seeing whether the Indian economy is resilient on its own or not, and whether it should follow the world or whether it should insulate itself from the shocks in the world. Because the importance of this is that the global situation is such that there is no place to hide. When all economies are falling, then where will you go? Then you have to build yourself only. And a very good example of building your own economy was with monetary policy, where during the pandemic, because it was not just the conventional monetary policy. A number of other tools were used which were very innovative. So it's a matter of survival and innovation. If you have to do it on your own, when everyone is sinking. And that is where the importance of resilience comes in. So that is about monetary policy and fiscal policy. I'll just touch on some of the other indicators which you have already discussed. So we have the external sector, and So there are some changes in exports, imports, but overall exports, imports seem okay. And foreign exchange reserves is doing well, and exchange rate, there's nothing to worry about. I mean, one would have liked it to appreciate a bit, but if it's stable, that's fine. And then we have FDI is also doing okay. FPI responds to the financial changes. So in that sense, external sector is okay. And then you can also look at other indicators like energy security. Like energy security is very important. And so in that, there are a number of innovations like the green finance initiatives. And these green finance initiatives will help to build resilience in the economy and also try to reduce dependence on energy imports. And financial stability, with financial stability in the external sector come a number of other issues like foreign exchange reserves, then integrating climate risk into banking supervision, then fortifying India's financial sector against external shocks. So these encompass a number of factors that we can look at. And one area where India has done very well is financial inclusion and digitalization. And financial inclusion is important for building the resilience. In fact, you may in your charts include some data on financial inclusion because um, you're able to extend financial services to the underserved populations, and therefore the economic participation increases because of financial inclusion and digitalization. And so the resilience to shocks will also increase. And in general, like for India and for all other countries, there has to be policy coordination. So policy coordination internally and externally. And policy coordination internally was executed very competently during the pandemic, where we had the combination of monetary and fiscal policy. Without that, we cannot survive. So, and with other countries, of course, it has to be worked out at a global level. Sometimes that's a good thing, sometimes it's not a good thing. Like if all the central banks um, start raising interest rates and this coordinated increase in interest rates, it may be fine, but it in some countries maybe that increase is not needed. Like if you look at the recession period of 2009 and 10, all central banks started to raise interest rates just by coordinated action, concerted action. But that brought the whole world into a recession because already the global economy was slipping into a recession. So coordination, but with degrees of freedom for the domestic fundamentals also. So that has to be taken into account. So, so I think that's what I would like to say is that your presentation is very good and you've done a wonderful job of analyzing all the data, and that I think if you just maybe just I haven't seen the report. Maybe in the report you could, or maybe it's already there, to talk more about challenges and resilience then, because all the answers are already there in your presentation. So thanks a lot. Yeah.
Thank you, ma'am, for providing a nudge to look at the medium term and therefore the longer goals of the economy. Would any of you have any comments to make on?
for coordination that is needed. Sometimes it happens that because of the impossible trinity, because countries are bound to raise their rates together. So it depends also on whether, because most of the central banks, there are inflation targeters, and like they don't intervene like RBI. They don't intervene in the foreign exchange market. So it's when they're if they want to stabilize their exchange rate, and then there is capital flows are there, so they can't have their independent monetary policy to pursue. So that is that, because there's a destabilizing pressure comes, so it might happen. The other point is on the unconventional monetary policy that India adopted during COVID. So that was uh, first of all, the the changing of interest rates was not going to change the investment environment during that point of time. So they adopted a various methods. Like one is, you have already said that. Accommodative monetary policy. That's a forward guidance that they are giving. The other was like they were selling long-term bonds and buying. They're selling long-term bonds and buying short-term bonds, so that the yield curve, which is in India is generally steeper, it comes to the closer, yeah, comes flat. And that's why we are still seeing that it's the long-term bond yield are now close to the short-term bond yield and the policy rate, this thing. So that is to reduce the cost of public investment. So that was the monetary policy support that RBI was giving for the stimulus packages that India took. So these are the kind of thing we can incorporate in our as you given your suggestions, and we can discuss these aspects in our analysis.
So both the questions, first about the impossible trinity, look. So in India also in the Monetary Policy Committee, so our mandate is very clear that maintain price stability, keeping in mind the objective of growth. So we don't discuss, or implicitly in our judgment, we take a call on what should happen to interest rates or what should happen to the stance of monetary policy. But we don't discuss intervention in the exchange rate, because we leave that to Reserve Bank to do. So some other department is doing that. So that way, but in our own calculations, it is there at the back of our minds that this has to be taken into account. But these things are not decided while fixing the interest rate. So that is like the judgment or perception of each member, and then you get the majority out of it. Yeah. So that is one thing. And second is unconventional monetary policy. Also, there was targeted support. Some sectors were targeted. So, like the collateral was reduced or the interest rate was subsidized. And so, a number of sectors benefited because of this. And the other one was, as you mentioned, the operations twist, which was to flatten the yield curve. And this was done in 2021 also. So, the effect has carried over after the pandemic, and that is why you see it also in the diagrams. And the third thing, of course, which is unconventional, but is done very often by the central bank here in India, is the forward guidance. So if you read the resolution of the Monetary Policy Committee, you will always find at least one sentence which will tell you how the RBI is going to act. Like maybe it will say, we will not increase interest rates until output increases or until the next fiscal year. You will find such statements there. So that gives you guidance that, okay, we are fine. So interest rates will stay low. So forward guidance is a very important tool and is used quite actively by the Reserve Bank, by MPC. I mean, the resolution, and then when the governor talks, he mostly gives the views of the MPC soon after the MPC meeting. So that's also a very important tool. And then also some macroprudential measures are there, and like what was done first in the LAF corridor, we had the MSF as the ceiling and the reverse repo as the floor. But during the pandemic, the reverse repo was also decreased. So this asymmetrically, first it was plus minus 0.5, policy rate plus minus 0.5. Then, but it was asymmetrically decreased. And then along the way, then that became a tool for the liquidity, and then Reserve Bank introduced the standing deposit facility as the floor. So, and then the symmetry in the ceiling and floor was restored. So all these measures are also taken, were taken during the pandemic period. So I think a lot of thought went into how to use monetary policy, not just interest rates, but everything else. And unconventional was very important during that time.
During the financial crisis, global financial crisis, in many of the developed countries adopted this kind of innovations in monetary policy.
Yeah.
And we adopted it during the pandemic. So
Yeah, so that quantitative easing which was done by US, yeah, and other developed economies. So the first time it was done here was, I think, 2019. But then after that, unconventional was relied upon quite a bit in India. And that was, so it was unconventional plus macroprudential. So plus you had the interest rate fixing. So these three together worked out quite well. Yeah.
Yeah, thank you. Anybody else who would like to raise?
As we saw in our presentations, most of the things are quite well in our economy, except FPI investment, which is mostly fluctuating in the recent time. And we saw every day there is like a new touch in most of the fluctuation in the stock market as well because of the FPI. So what are the reason behind it and what we can do for it?
We discussed in the slides the key reasons for the volatility. One is the geopolitical uncertainty that is continuing, and the other thing, that new thing that has happened, is the China stimulus that has resulted in reallocation of resources and funds from foreign portfolio investors from India to China. So there is a reallocation that is happening, and because Indian stocks were already very highly valued, so now there is a movement away from India to other countries, primarily China. But we think that it's a temporary phenomenon because the stimulus measures are mainly on the supply side. They will not be something which will improve the demand pattern in China. So there is this sentiment thing that because the stimulus measures were more towards market, so there is this spurt in China's foreign portfolio investors inflow than outflow from India. Thank you.
Anybody else? Yeah. Yes, please.
I have two questions. One is the subsidies. It has been budgeted to decrease by 7.8%, but in the first quarter it was flat. So in what fields are they trying to decrease? Because we also mentioned Narega subsidies are increasing because reverse migration was mentioned. So what's the decomposition of the decrease in subsidy? The second question is in terms of state liabilities to GDP. the central government has largely reduced complete off-budget liabilities. What's the status of off-budget liabilities in the state government, or how are we considering that? Thank you.
So here subsidies, we've just taken major subsidies, food, fertilizer. And as regard NREGA is concerned, it is part of the grants because that is a central sponsored scheme, and that also we don't see after the boost in during the pandemic period when the allocations was increased considerably. We don't see that happening. So it's been around 86,000 crores for last 2 years and all. So that does not form part of the subsidies also. Off budget is an altogether different story. While central government started declaring off budget liabilities, but then there are studies which shows that the statement 27 actually, which captures these off budget, are not fully disclosing all that. So that is there. State level also there are huge there are issues with off budget liabilities, and we have a paper which is available on our website also. You can have a look at that, where we look at some of the for some of the states the off budget liabilities. So now states have started disclosing those off budget liabilities, and so we did an analysis, so you can look at it. So there are few states where you will find off budget liabilities to be very high. So
Any other questions from the room? Yeah.
Thank you very much for the presentations. They were really thought-provoking. I would like to just begin with what ma'am said in the end, that when we talk about resilience of economy. So, Dr. Manish, when you presented about the variation in state performance in almost all the indicators, so do you think that this variation can be a worrisome trend in the longer run, because there are states which have been performing well, but there are other states which are showing downward trends, including in one case you have shown Punjab and even Haryana. Bihar is a continue to remain a worrisome case. So do you think that will have an impact on the long-term resilience capacity of Indian state, or do you see that this may be balanced out? So maybe in some indicators, if some states are performing bad, others are balancing it out, and it may not actually impact that. Thank you.
so variation in across states is not new. It has been there all throughout. So in the recent finance commissions have not given a state-wise path, which the 13th Finance Commission had given, where they took into, though it was a one-size-fits-all kind of an approach, but then for certain states like Punjab, Kerala, West Bengal, which were fiscally stressed, they had a different glide path, but then all coming back to 3% all. So we need to look at individual states' finances and come up with specific sector-specific, state-specific interventions to address this. To begin with, each state has its own FRBM legislations, and but they don't. They all say that it has to come down to 3% uniformly. Gujarat also brings down to 3%. Bihar also brings down to 3%. So one has to also take a look at how each state, keeping in view the state-specific issues, address and come up with a path which is more desirable for that state. So it need not bring down 3%. It should not bring down to 3%. Say, to give you an example of UP has budgeted for a huge revenue surplus of more than 1% of GSDP, but then it lags behind most of the states in terms of various social indicators. So that is another issue, that states do not spend on sectors where you need to spend just because you want to maintain your fiscal deficit or the FRBM targets of showing revenue surplus or not even revenue balance. So these are issues which also states also need to understand and come up with a more realistic picture, keeping in view the needs and where interventions need to be made.
So, so quickly, someone pointed out about the pullout of the FPI. And in addition to that, if you look at the yield for the private debt market, there seems to be an inversion of the yield. And as theory would say, the inversion of the yield curve for the corporate debt, and typically, as they say, the theory says, it's an indication of a recession. So, do you have any thoughts on that? I mean, given that we see that FPI has gone down suddenly, and also an inversion that we see, and not so much for the government debt, but for the private debt. So, any thoughts on that?
So typically inversion of yield curve is considered as a leading indicator for recession. But we have seen even in the US, this time around it has not played out, because in 2023, 2022, the yield curve was inverse in the sense that the short-term yields were much higher than long-term yield. And it was, various indicators were showing that it would lead to recession, but it did not. So this time around, the nature of shocks and the drivers of the economy are such that the flatness in the yield curve or the inversion of the yield curve is not considered as a indicator for recession. Typically in advanced economies also it has not played out, and in India definitely not, because the drivers of yield of short-term bonds and long-term bonds are distinctly different in India. The short-term bonds are more sensitive to monetary policy decisions, whereas long-term yields are more sensitive to fiscal policy, borrowing requirements, and the trajectory of the 10-year bond yield. So even in India, we saw a period where short-term yields were much higher than long-term yields, but that did not translate into recession. And currently also in corporate bond framework, we are seeing that the short-term yields are higher, but that's a idiosyncratic feature of the corporate bond market rather than an indicator of recession. So I think in Indian framework, it needs to be, we don't need to talk about that as an indicator for recession. So it's not like that, because the market conditions are shaping the yields in that way.
Okay. If there are people who've joined us online who would like to have questions or comments on the presentations, can we invite anybody who would like to ask a question? Okay. Perhaps there is not, there's not, no. The green is NIPFA. Yeah, everybody else is on mute. So, okay, so that sort of brings us to one stage in this conversation. Since we have Professor Dua here, we would all like to sate our own curiosities, I guess. So would you be willing to take a couple of questions? Thank you. Would you like to go first?
Yeah. For me, I thought that was really interesting, what you said. Look at all these numbers from a perspective of what does it tell us about the resilience of the economy. We all know it's the fastest growing and so on. And I think that is, our numbers seem to suggest, I'm taking a very broad picture, that virtually any department we look at, it's turned out to be, pretty resilient. The fact that when the world is in great crisis, we continue to grow at 7% is, and with modest inflation, is quite amazing. And our foreign exchange is now going through the roof. But resilience, I mean, as you mentioned, is a thing of how you handle shocks, which are episodic. There's a different set of issues relating to, and as you put it in a perspective, if you're thinking of a long-term thing, Viksit Bharat by the middle of the century, then we need to look at other kind of structural challenges, and the ones that I very often think about are, I think the world is going through a period when we are having at least three technological revolutions at the same time. I don't think we have ever seen this historically. One, of course, is the energy transformation because of response to climate change. And then there's this artificial intelligence, which is going to completely change the nature and the manner in which economies function. As you said, this can have both positive and negative effects. And the third, which is not often always talked about, is also a biotechnological revolution, which is also underway. Is going to completely change the foundations of many things, not just the medical profession. So that's a question I was, how are we, uh, addressing this? Are we addressing them? My own sense, I looked at this briefly in the context of the budget, is that while we are touching on all of them, I think our interventions are exceptionally modest. I mean, compared to when you look at the people who are really competing to capture the frontier of technology, like the US, China, and so on, we are not really players, and that's my sense. But I'd like to know what you think about it.
I think that you are right that, it depends on how much we are investing in this. But if you look at renewable energy, then many innovative schemes have been introduced on green finance, and it was given a lot of importance in the budget also, and last year's budget as well. And um, so slowly, I think the message is spreading that this is important. And uh, as regards technology, yes, that will take time because, like AI, you have to understand it also. So one cannot just simply say we'll move to AI. And uh, but I think it has been implemented, but it has its negatives and positives. The other biotechnology, it will take time. Perhaps other developed countries are quicker in implementing these. But I think there's no harm in having a moderate approach to it because you have to understand the negatives and the positives of this change. But for renewable energy, I think quite a few steps have all. You are doing well on that. Yeah. Even the private sector has been encouraged to invest in this. I think that they are okay.
Can I add to the questions?
Yeah.
If in a medium or a long-term perspective, how do you think about the need for employment? That is like elephant in the room.
Yeah.
Dividend.
Mm.
Why? Because we don't know if it's a democratic disaster.
Yeah.
Should we be worried about it? Is that an active concern in how we look at policy and the country? Are we being too incremental in our policy? Is there something that should be on the policy maker's table as an issue to worry?
I would think instead of just looking at numbers, one should look at education and skilling because that would give us more stronger standing, like in terms of getting a job, becoming employable, rather than just looking how numbers are moving. We should invest more in social welfare programs for education and skilling, vocational training.
Ma'am, I was just curious that when ma'am was talking about the Viksit Bharat vision that we have, and our growth rate is hovering around 7%. So what can be the sunrise sectors that we can focus upon to propel our growth rate?
I think the sunrise sectors would be the startups. We have to rely on startups and SMSEs, MSMEs. I think these would help to propel the growth rate. Yeah. IT sector also, so yes.
Anything else you'd like? The question or a comment? We have another 20 minutes. Okay, so then we'll bring this session. Yeah, please.
No, this is partly in response to the question you raised
Yeah.
and also raised that, and I'm not addressing the question of PAMI, it's just we are discussing that we have got used to looking at everything through the lens of growth. Growth, not growth of GDP, which is GDP actually also an index. It's a whole bunch of things being produced multiplied by a price vector. But we could also look at things, especially, as you said, elephant in the room being employment, have everything from the perspective of employment. So the human beings are what we are all about. And then growth of production then becomes, if you will, a derivative rather than employment being a derivative of growth of output. And from that point of view, I'm just saying the way I tend to look at it, we have, I think, an immediate problem and a longer term problem. The immediate problem is that, and our employment definition, which is not just ours, the ILO's definition, the way you catch it, just does not catch the problem because open unemployment is relatively modest in India, around 7%. The real problem is underemployment, low productivity, close to reserve marginal productivity, and so on. And those numbers are huge. The backlog of underemployment plus unemployment is very large. So now, for addressing that problem, we cannot take, the thing of long terms, because if you educate a child today, it's going to be 10, 15 years before that child is ready to get into the workforce and then get high skilling and so on. So for the immediate thing, I think what we need to do is, while all sectors are naturally becoming more capital intensive, that's across the board, that's the nature of competition is driving it. But there are still very large variations in employment intensity across the thing. And in fact, it was there mentioned in the economic survey, and I'm very pleased to see that the finance minister picked it up. She actually has defined this term of not just, the PLI has been there, production linked. Now she's got employment linked incentives. But I think the way this was introduced, there's a lot of room for improvement because you would take this whole spread. A lot of people have done work on this. One recent thing I was using is the NCR study. How many more additional jobs per 1 crore of output. And you see that there are some which are very large and some already large players, the traditional industries like, garments, textiles, of course, construction and so on. So the thing is, can you give them incentives? These are not handouts. These are not subsidies. These are incentives, just as you're giving a PLI for increased production for increase in employment. And these would typically not be high productivity jobs of high skilled and relatively low skilled jobs. But this is the nature of the workforce. Their skills are low. This big backlog are of people with very low education, very low skills and so on. So you have to find jobs for them in the short run. But at the same time, if you walk on two legs and you get into the sort of thing that Kwame was talking about, you get your base of education right. We have a lot of work to do there. And build on that high skills and so on for the workforce of tomorrow. And they have to be prepared for these things I was mentioning about, a world which will be very different technologically, AI and all that. So I think this is the way I would look at. I agree with you. It is the big elephant in the room, but needs to be split into the immediate set of measures and the long-term strategic approach.
I I just have one question on how it plays out, because let's take you want to encourage textiles. You have to ultimately find a way for that to find a market. It is not just incentivizing more fabric to be produced or more activity in the textile sector, but the next step. So the entire supply chain, if you want to call it, until it hits a market and it gets traction, then becomes a responsibility, because otherwise we are just going to replace existing jobs with incentivized jobs. And this is an old problem we've had with all of our incentive schemes, SEZs included, where you shift from unincentivized to incentivized and you take whatever incentives are being made available. And that will continue to happen unless the final demand changes. And without addressing that, we can't just do trigger a correction here. And so we are talking about the macro and the composition of demand domestically or internationally. And if you're not keyed into that, perhaps you're not answering the question.
I have two thoughts on this. One is, and this is something I hope when people probably get shocked. You know, from the beginning, we have underpriced capital. For a country which is so poor, so short of capital, you look at the 7% rate. You know, Chakravarti committee years ago had talked about having a 1% real income on people who are holding the savers. Whereas you look at what fixed deposit rates and banks are giving you, and it's why would anybody get shocked? The bank deposits are not growing. I mean, investors would have to be really stupid to keep putting all their money there when there are options elsewhere. So now the thing is, what do you do? So I'm now talking about the wage rental ratio. Now our wages are already so low. You can't obviously reduce that. Now, so do you raise the interest rates? I mean, people would go crazy. The whole debate is about when to reduce interest rate rather than raise them. So this is where my view is that where fiscal policy can play a role, effectively reducing the cost of production in labor-intensive industries by giving these. You're doing the same thing with PLI for
Budget this year. That's what he said. That's
what I said. But what they have done is they are basically subsidizing. If you hire a new person, you get this much. Mainly, they're subsidizing the cost of contribution to PF.
Yeah.
But she's also got a two-track thing in mind, because there also has apprenticeship program, which is something, and more than 100 companies have now signed on. I'm really very hopeful for that. And in fact, the one that's just been launched is AI-related apprenticeship. So I think they're thinking along the right direction, but it's not to be done. But to get back to your main question, so one is if you reduce, so I'm really talking about making these labor-intensive industries more competitive. It's all at the margin. Right now, at the present wage rental ratio, resources, capital will naturally flow into capital-intensive sectors rather than labor-intensive. So change that reality. It's all about relative profitabilities, right? But to still come up with a question, these sorts of industries I'm talking about will actually be producing for low wage income consumers and so on. But certainly, this you get into the Caldor type of growth distribution models, you cannot ignore the fact that if you keep on having very low purchasing power for a large bulk of then the demand will obviously not get generated. You will then end up with what used to be called the Brazilian model of growth, where there's this affluent group buying for each other and so on. And at the end of the day, in modern economies, not that I hope we won't go there, but halfway there, that actually modern capitalist economy don't really need consumers because the state can keep spending more and more on defense and so on and generate all the demand you want. And it doesn't matter if people don't have, it's a horrible thought, but it means you don't care what your working class is unable to consume, but the state keeps spending and creating demand. These are long questions you have to think through, but but there are all sorts of things.
Madam, can I kindly come in, please? I'm Dr. Vishal from Karnataka. Is it?
Yes, Dr. Vishal, please.
Thank you. Thank you, madam. Thank you, everybody. I'm slightly late, but at the sub-national level, practically as Secretary Finance, as Secretary Planning, I'm seeing two important things happening. First, whenever decision-making happens in the government, we look at ICOR, cost-benefit ratio, cost-effective ratio. Practically on ground, the multiples of employment opportunities, the multiples of benefits which we are envisaging from CAPEX is not coming in. Two main reasons for that. First, CAPEX is suboptimal because we are spreading ourselves too thin. This is the first observation. We can do 10 roads, we are doing 25 roads. We can do 2 hospitals, we are doing 5 hospitals. So nothing is getting completed. So this does not actually end up in giving outcomes. It may do suboptimal outcomes first. Second, we are moving without completing many of our hard infrastructure into a lot of welfare schemes. One single year, our GSDP expenditure for subsidies jumps up by 1% or so. These two things are happening across states. So how do we ensure sustainability happens is either we ring fence our funds so that certain things get completed, or institutions start raising their own funds to manage themselves. These are two practical ways of doing this, whether it's an ITI increasing fees or getting a hospital on a different cost benefit model, like increasing the revenues. If we do this, then all our other things at a macro level we actually translate on ground. Otherwise, it's just the private sector. But if we are inefficient in the public sector as government, we are slowly going to push the private sector into a higher cost of funds. So this is something which I've been looking at from the last 3-4 years. It's going to be slightly tough unless the welfare thing and the completion of CAPEX happens in a time-bound manner. These are two observations of mine.
Thank you. That's interesting food for thought. The only slight aside I had on that is there a pressure to announce new projects without necessarily completing old projects? Does that pressure continue? Okay.
Yes. The other thing is, ongoing project is there. We have protected it, but they announce a welfare scheme. That takes away your fiscal space completely. As you know, the guarantees from 0 to 52,000 crores, almost $8 billion, $7 billion. So that changes the rules of the game. What you would have completed, you don't have. So that's the competing interest which comes in.
Sure. Thank you. Anybody else has a comment before we decide to bring the session to a close? Okay. Do you have a comment?
No.
Anybody else? Any of you? Okay. Thank you very much. It was a useful discussion. We unusually finished, I think, 15 minutes before time, but it was thought-provoking. So thanks to my colleagues, to Dr. Mandal, and to Professor Dua. Thank you very much.